Good afternoon, everyone. Thank you to see you all here. Well, so imagine financial fairness is no longer an ideal, but a reality powered by artificial intelligence. Well, that is actually what we are doing in lending industry, and that is the future we are steering towards in the entire financial sector. I'm Kefirah. I'm a practitioner, I am an advisor, as well as an entrepreneur. So several years ago, my business partners and I started our boutique consultancy, FinServe Expert. We aim to help our clients to achieve business model innovation through emergent technologies. And we consider ourselves extremely fortunate to be able to co-author some of those very amazing success stories. Then, followed by those successes, we were invited to partner with regulators and central banks across the globe. So, well, this is the footprint that we've made during the past several years. All the green area are places where our thought leaders have delivered success in. And this map also represents our journey of witness the transformative power of technology that we've employed and worked with. Recent years that we observed an undeniable trend in AI adoption in financial sector, lending in particular. So as this picture is showing, is quite self-evident. So AI is really becomes an undeniable trend. Then let's take a look. Focus on the lending industry, credit scoring in particular. I mean, we see a rapid market growth in credit scoring sector. This is not surprising. Why? Because credit scoring is such an important topic when it comes to risk management. But also, if done well, it helps the lenders to better engage with your customers and to be able to personalize your service and product around. So whether if you are a lender or you are an investor or a practitioner like I am, so our awareness of the importance of credit scoring innovation will all drive this growth. Okay, so now we understand our drive behind and our sense of urgency. Also, there is an objective, undeniable trend of AI advancement. What else that we should pay attention to? So we should pay attention to the drivers and accelerators in our eco-lending system. So first of all, we have the ever-growing digital ecosystem. What do I mean by that? So when I started advisory work in 2016, the capital venture that went to the credit scoring and to the embedded business model was only 81 million. That was 7 years ago. But this number soared into 4,000, almost 4,000 by the year of 2021. So it's almost like 50 times than it was 7 years ago. So that is how much rapidly this ecosystem is ever growing. The other driver is that alternative data is no longer alternative. Now we have more and more empirical evidence to prove that transaction data, especially spending data, they are a more effective predictor to the loan performance than the FICO score or FICO-based credit scores. The third, we have our ecosystem and the interoperability is largely enhanced by the open banking and open data initiatives. So for now, just as we speak, there are already 65 jurisdictions have successfully adopted this kind of framework. And we are going to see more coming in the coming years. Last but not least, let's admit that we are operating in ever customer-centric markets. Now, the customer's behavior and expectation is shaping the way that we design our service and our credit scoring solution, because we do want to know them better, don't we? So yeah, this is the ecosystem and the surroundings that we operate in. I figure it is important for us to understand them because it is like the neural system in human body. We don't easily see them with our bare eyes. But however, understanding how each element creates the synergy and how they work underneath will help us understand how the system functions. Well, up to now, some of you guys might be very optimistic and saying that, well, this is a very friendly environment for us to innovate. You are right. And some of you guys might already start concerning about, oh, it becomes competitive because we have such a friendly environment, there will be more innovation coming on. So how do I stay competitive? Well, according to my experience advising central banks, regulators, and my practical history when I perform as a CTO for fintechs, I do have some perspectives to share. So when it comes to credit scoring, I think first it has to fulfill the very basic business need. But besides that, there are 3 other boxes to be checked. Let's find out one by one. So first of all, it has to address the challenge of financial inclusion. Well, M-Shwari, the loan product that's working on top of the M-Pesa mobile wallet, launched in Kenya in 2014, serves a great example of that. So after 2 years, the M-Shwari credit scoring solution got launched. The country's GDP doubled, and that's major because of the SME job growth. That is the power of a great credit scoring solution and how that can actually facilitate the growth of the economy of a country. Well, since then, everyone is ambitious to be the second M-Pesa. Yeah, I've heard that a lot from the CVs and from the clients that I'm working with. But let's not forget, driving that financial inclusion and being the second M-Pesa might be not the only way that you can champion your innovation. There are several other angles to look through. Let's look at it. Transform the way business operates and reshape the relationship between lenders and regulators and borrowers. These are the other 2 angles that, from my perspective, is also important. Well, so the lending industry resembles a very big puzzle, with each piece has its own challenge. So from the borrower's perspective, even though now we have alternative data available, they can access to credits. But let's admit that getting a fair-priced product is still quite hard. So actually, half of the world's population is able to access to a fairly priced loan. I didn't make the number up. You can check it up. I mean, fair-priced loan. So loan product is still pricey. However, from the lender's perspective, some of the lenders, they do offer fairly priced loan products. But however, they do have to be convinced that the person who they lend to are safe to lend to, which means that inevitably they take a very conservative approach. They only lend to a limited spectrum, which then subsequently creates exclusion, but they didn't mean to. There are other part of the lenders, they are willing to take higher risk. They do lend to wider spectrum of clientele, but however, to offset the risk they are bearing, they need to increase the interest rate, which then make the loan products pricier. All these observed through the lens of regulators. What concerns the regulators is that nowadays more and more consumers is showing the characteristics of vulnerability. More and more consumers are over-leveraged. They are more debt burdened. So, well, is there a solution, credit scoring solution there can actually resolve the issue and do their innovation through these two angles? The answer is promising, is yes, because today I'm going to share with you guys a real case that I've personally designed and led the build of. So this solution recently just got admitted by the UK FCA regulatory sandbox. Also, it was a reference case that made by the Central Bank of Thailand because they think this is a great case study for driving ethical lending. So let's take a look at it. Well, the solution is we build an algorithm that's running on the open banking infrastructure, gets the real-time current account transaction data, and output a rating that predicts the likely loan performance a specific applicant made. Well, worth noticing here, I didn't say give the individual a risk ranking, nor did I say that give someone credit worthiness. I said to predict the loan performance. Why did I make such an effort to make this distinction? Follow me. I think my story will explain why did I say that. So when designing the solution, we think two things are very important to be evaluated, and they have to be evaluated separately. One is human behavior. The other is the product suitability. Human behavior is more straightforward. So think about that. Do we control the inflation rate? Do we control the stability of our employment? No, that are not in the remit of our control. But what we control is how do we behave and how we manage our cash in those adverse financial situations. So instead of do the stress testing to forecast the financial stability of an individual, the algorithm focus on understanding human behaviors. So based on that, we can predict how that individual is likely to behave in all possible financial situations. Let me give you an example. There's a young lady that we based our initial study on. Her name is Kira. She is a social media influencer. Basically, she has no spending pattern because she runs a YouTuber, so which means she could get the income, a lot of income within few months, but that could go like half year. She didn't earn anything. But when we studied her spending data, what stood out in our model was not how unpredictable her income patterns is, but how predictable her behavior is. So when we visualize her behavior in burn-down chats, the durance of length of when the income hits is unpredictable, but the decline of gradients remain largely unchanged. But what does that mean? That means this individual made sure that she never ran out of cash before the next income hits. So that is one of the example I just gave you, the spending pattern that we are looking at. So together with the other 240 factors, the machine is able to picturize a very comprehensive profile of the individual's behavior. We then translate that behavior into a score. We call it financial capability score. So that's the first point. And concurrently, we also study on the suitability between the applicants and the loan, because no matter how well I can manage my cash, if I apply for a loan that is too expensive for me to apply, I could still default, right? So after these two elements get analyzed, the machine outputs a combined rating. It is this combined rating that we use to predict the loan performance. And worth noticing, since this is running on top of the open banking infrastructure, we are able to do the data curing in a monthly basis so that risk control does not stop just after the loan get originated, but we can continue monitoring it throughout the entire loan life cycle. Right, so let me very quickly show you how the model get configured. So here comes the interest part. The model is able to tell the lender what is the probability of default of a specific loan that applied. And also, it is able to tell the lender how affordable this individual is. So the lender is able to introduce different loan products for the individual to choose, but also within the remit of that person's affordability. Some of you guys observant might have already noticed. So actually in here, if the lender inputs the proposed loan term and loan interest at a lower rate, as long as the behavior score fall into a healthy range, offering a lower interest rate can actually enhance the loan portfolio's performance. I know it kind of sounds counterintuitive if you didn't hear me walking you through the solution, but it is actually true, and we've proven that by configuring this model with our lending partners. So that's the first message that we want to get across to our lending partners. That is a link between human behavior and product suitability. The second is that, okay, you might ask, what about the individuals that whose capability score is not actually falling into the healthy range? Here is the most interesting part, the business model. So let me share with you guys how did one of our lending partners did. What they did was that they would select several individuals whose capability score looks okay, but not quite there. However, they have the good affordability. What they do is that the lenders would lend to this individual with a slightly higher interest rate, and then monitor their behavior score in a monthly basis, then agree that the increase of your behavior score can actually set off your loan interest. Once we see your score increased, then we can give you a fair interest rate. So that is actually a really, really genius business model, because this is by creating a win-win situation. The lenders is actually cultivating a healthier spending behavior while reducing their own lending risk. So this is the ethical lending practice that we are driving towards. The other thing that's worth noticing is that applicants stay anonymous to the model until after they get elected. We do that by design. The first reason is that we want to remain ethical. We want to do our best to remove any bias, because to the model, whether you're, so regardless what your name is, what is your occupation, where you live, to the model, you are just a unique behavior profile. And the other reason that we could do that is because we were blessed by the infrastructure, by the interoperability. Those is a little bit call back to the things that we discussed earlier, that we could leverage the ecosystem. So yeah, this is the story that today I would like to share with you guys. So after this sharing, if there's only one takeaway that I can share with you guys, I might say that, guys, my team who developed this model is actually the core team who developed M-Pesa. But it's very differently from the years that happened in Kenya, because the model actually running in a developed economy. It didn't make any difference on the algorithm apart from the more advanced AI, but the business model innovation is the key. Besides it address the financial inclusion challenge, it also innovates the business model to adapt the ecosystem it's operating in. So yeah, solution isn't something that attracts CV or make things more interesting. It is always the business model the technology enables. So thank you. My name is Kefirah. I believe that technology can make our living in a better place, and I'm passionate about to contribute my effort in this. Thank you.